म्यूचुअल फंड एसआईपी करते रहते हैं।
एसआईपी मोड ऑफ इन्वेस्टिंग।
हमारी पिंकी के पैदा होने पे हमने उसके नाम पे इंडेक्स फंड में एसआईपी स्टार्ट करा दिया था।
Shut the up and invest in mutual funds.
And this is why you should invest all your money in SIPs. Wanna know more? Follow me at Finance with Shalini.
Wow, bro. So how much do you invest in SIPs?
Bro, I don't invest. I get paid more talking about SIPs, so I don't bother investing at all.
Everyone has been talking about the power of systematic investing through SIPs to generate long-term wealth. Put a little of your money aside, use the power of compounding, become rich, and retire early. And now, almost everyone you know is investing in SIPs. In fact, more millennials are investing now than ever before. And that's a good thing. Due to campaigns such as Mutual Fund Sahi Hai, ordinary people like us are setting up multiple SIPs on various apps and platforms, investing in schemes such as Nifty, Small Cap, and Mid Cap. As a result, the number of SIP registrations is skyrocketing in India, indicating a rise in intelligence among retail investors who now opt for SIPs instead of seeking multi-bagger stock. But is it smart to just invest in SIPs and forget about it? Maybe not. Obviously, everyone is sacrificing a little income now in hopes to become rich in the future. But the rich are still at an advantage. Rich people invest with the aid of wealth managers. And these people promise them high, market-beating returns through active wealth management. In fact, the demand for personalized wealth management has soared so high in the last decade that this has created a $63 billion wealth management industry, making it one of the fastest growing industries in the country. About 32 portfolio management services gave one-year returns in double digits in 2022, ranging between 10% and 35%. The top performer, Molecule Ventures, has generated returns as high as 35.2% in 2022. Rich people pay them money to make more money. These wealth managers charge as high as 2.5% along with profit sharing fees for managing the investments. But retail investors don't have that kind of money. Wealth managers are able to generate such high returns because they are diligently tracking the markets with a dedicated team of experts and advanced analytical tools. On the flip side, retail investors are just being told to invest in index funds through SIPs. It seems contradictory that while wealth managers are using cutting-edge tools, retail investors are being offered simplistic solutions. Do we leave retail investors in the dust? No, there's a solution. While we're not saying that SIPs are inherently bad, actively managing your SIP can lead to significantly higher returns, much like top fund managers. Rebalancing your portfolio, watching market movements, switching mutual funds when one fund is not performing so well, reading news updates about fund managers, this is what active investment management is at its core. And yeah, that sounds like a lot of work. This is where dynamic SIP comes in. Imagine being able to manage your portfolio like an active fund manager. Watch and learn this simple approach and start investing like the rich already do.
Oh my god. Okay, let me just check my portfolio. That. Oh my god. Portfolio is down by 10%.
The market is down, but the nation wants to know why is the market down right now?
Oh man, the market is down. I better withdraw all my investments. Not bad, huh? Nice pictures. Glad. Oh wow, the pictures on this phone are so much better. What camera is this? Arey yaar, I should get the same phone. I'll do one thing. I'll start investing now. Put all my money in SIPs. I'll get the same phone.
You never take me to trips. Learn something from other boyfriends. If you do not take me to a trip this month, I'll break up with you.
I'll just do one thing. I'll take some money out of my portfolio and spend it on one Goa ticket. Or kya?
Dynamic SIP involves choosing the most suitable SIP amount based on the investor's financial goals and actively optimizing it based on market conditions. In simple terms, increase your SIP amount when the market returns are decreasing and decrease your SIP amount when the market peaks. It's pretty easy to understand. Let's look at the math. Here is a graph that compares returns between a vanilla SIP, a step-up SIP, and a dynamic SIP over different time horizons. The data provided shows that over different time periods, dynamic SIPs generated the highest return compared to plain vanilla and step-up SIPs. In fact, over a 3-year period, a dynamic SIP generated 17.74% returns, which is 5.25% higher than a plain vanilla SIP and 5.9% higher than a step-up SIP. This trend was consistent across different time periods, indicating that investing in a dynamic SIP could lead to higher returns in the long run. The clear implication is that flows in the stock market are highly cyclical. When returns decrease, SIP flows tend to stagnate or decline. This is the point at which future potential returns become very promising. If you observe the SIP trend in the last 3 years, people withdrew from the SIPs between April and October 2020. If they had invested more at that time, the outcome in 2021 and 22 would have been different. Conversely, people started increasing their SIP commitments in August to September 2021, even though the markets had already reached their peak in October 21. After these investors complete their 24-month cycle of SIPs in August to September of this year, they will likely become convinced that the stock market does not provide any return and that they should invest in an FD instead. This would be the ideal time to increase equity commitments. The stock market's returns are cyclical, meaning that a period of high returns will eventually lead to a period of low returns, and the cycle repeats itself over time. However, retail investors tend to be their own enemies by making the wrong decisions at the wrong end of the cycle. They tend to allocate large sums of money at market peaks only to withdraw as they get disillusioned by the lack of returns right around the time when the market tends to make an important bottom. Emotional intelligence, or EQ, plays a vital role in investing, and many people lack it. They tend to invest when the market is rising and withdraw when it falls, exhibiting inverse actions. This lack of EQ is also the reason why average lifespan of SIPs is considerably low in India. The reason why this actually works is that stock markets move not just on numbers, data and logic, but also due to the mass psychology of the crowds. Like Warren Buffett once said, it's only when the tide goes out you know who's swimming naked. But you have a job, and so do most people. It would be more beneficial for you to increase your income by progressing in your career than become a super stock market investor. That's where Stack comes in. Stack actively optimizes SIPs to ensure market-beating returns by doing all the above-mentioned research work for you. The one aspect you have control over is when to increase and when to decrease your SIPs. Although we are always happy to recommend that to you, but you make the call. Finally, we would like to summarize everything we just talked about in 3 key points. Don't just invest in an SIP and forget about it. A market dip is an opportunity, not a cause for panic. Increase SIP amount during a dip and vice versa. With Stack, you can invest like the top 1% of India already does, helping you join 1 crore club as soon as possible. The link of the app is in the description. We're covering the mainstream finance headlines like nobody else does. So don't forget to like, share and subscribe to stay updated on everything finance and gain access to content that will teach you how to enter the top 1% of India with the power of investing.